gas prices go down? When will gas prices go down? I'm actually going to show you that gas prices are historically low, and soon you're going to be paying $8 to $14 at the pump for gas for your car. You're going to be paying $8 to $14 or more per gallon at the pump in the next short time frame. Could be 2019, 2020, but it will be very short. I'm also going to show you where gas prices are headed, back with data as well. This is the crude oil prices for this past 70 years. As you can see, it's been a recent dip. The gas prices at the pump are going to be about 4% of this number here. So gas right now, you're looking at, it's below 50 right now. So I got some data. Here's data. It's price per barrel. And I just got this from various charts. Price per barrel. The Dow, this is the Dow Jones index right here. This is a ratio that I put together. This is just the price of the Dow divided by a price per barrel of oil. You get a ratio here. And I'll go over this ratio. This is the price per gallon. And this is just a percent. So it's about 4% of the barrel, will get you this number. But I'm going to show you, time tested data that I went back, actually gathered a few decades worth of data, just so you can be confident in knowing that the gas prices, oil prices are set to explode relatively shortly. Should be there already, but that's neither here nor there. So let's see. So you can see during periods, we'll talk about the highs and lows. And in the 70s, it was record high inflation. Prices soared. Gas prices, what you need to realize is that they're cyclical. They go from being overbought to being oversold. And they just do these wild swings as they've been doing. And if you know something does these wild swings, you can kind of project and plan. This is no different than summertime and wintertime temperatures. It's cyclical. Not everything, but huge majority of things are cyclical. They operate in cycles. So wintertime, you have, the northeast of U.S., or depending on where you are, you have extreme cold temperatures. Summertime, you have extreme warm temperatures. And you can kind of bet in the winter, it's going to get cold. In the summer, it's going to get warm. This is just how things work out. There's no average temperature in the majority of the world, at least. Some places it may be more, but I'll show you the price. So this is the Dow. Let's get into the data. This is the Dow. Let's pick 1973. Dow was 900. Price per barrel of oil was only $4.75. And these numbers are low, or relatively low, because the Dow is a representation of money in the economy. So the Fed has printed a massive amount of money, which has caused the Dow to go up, which has caused all prices to go up basically over time. That's the key. All prices don't go up immediately. They all go up over time. So that's the key with the oil price projection. There's a lag, which I'll show you. Which is going to cause the price to go up over time. So 1973 was 900, price per barrel 189. You can see that this ratio actually decreases. We can go back. It actually decreases in points where you have high oil prices. This ratio hits single digits. That's key. Points where you have high oil prices, this ratio hits single digits. So 1970, this ratio was 206. Price per barrel, $3. This is per barrel, not per gallon. I didn't even get the per gallon prices, but you'll see it later. 1973, ratio 189. This is when it starts to get low. 1974, now we have high oil, which is cyclical. Now the winter and summer, that happens once a year. The problem with this cyclicality is that it could be every 30 years, every 20 years. Whenever that ratio is out of whack, it doesn't stay out of whack long. It always reverts back to the single digits. So you see single digits here, or actually, yeah, not single digits, double digit ratio here. You get high oil per barrel. So look how the price went from $3 per barrel to 25. And this is the ratio. It gets low. It's 30 here. This equates to 86 cent oil, at the pump, right? 1980, low 25 equates to $1.19 at the pump. Okay, now I'm going to show you. We'll scroll through. This is when the Fed, they pretty much stopped printing money, so it caused the Dow to go up. So we see the Dow increasing, but the ratio, you see the Dow increasing, but the price per barrel was increasing as well, which kept a low ratio. Now you can see the ratio starts to go high. All right, and here's the price per gallon. So 97. Look at this ratio. This 400 ratio is out of whack. It could be for whatever reason. We're not going to get into the actual reasons of production and those things, but just know that this ratio is out of whack. This 400 ratio is kind of like, if you're in, let's say, New York City, it's kind of like having 90-degree temperature in winter. That day, let's say Tuesday, a regular Tuesday had a 90-degree temperature. That 90-degree temperature in the winter in New York is not sustainable. In a week from now, 2 weeks from now, a month from that Tuesday, you're going to revert back to 30-degree, 40-degree temperature based on historical data. This is the historical data. So you can see price is out of whack here, right? You had $1.23 per gallon. Price per barrel 18. So look, the price per barrel was the same price it was in 1977. Meanwhile, the Dow, see, all the money was going into the Dow. Meanwhile, the Dow went from 831 to, I forget where I was. To 7,000. So the liquidity in the economy increased drastically, but oil temporarily didn't show this increase. And one of the main reasons is because of the production. A lot of these oil production manufacturers and companies, they underproduce when the Dow is high, because a lot of the money that goes to the Dow doesn't go to the oil stocks or the oil companies, for production, exploration. They typically, may go to technology companies and those things. So let's see. Look at 98, went even higher. This ratio out of whack. Price per barrel, $11 at the pump, $1, right? $1.06, let's say. So then, let's see what the price per barrel, or let's look at what the ratio does. Ratio normalizes a little bit here, floats around here. This is like a stream buy for oil. I mean, if you were buying like oil exploration companies, you could have got massive returns here, right? Goes down, 2006, 2007. Look at 2008. 2008, it hit the double digits once again. So this whole point, it's been getting normalized, and then it passes. Let's say the normal may be 200. I don't even know. Normal may be 150. But we don't need to know that data, the normal. We just need to know the extremes so we can kind of plan and we can kind of invest accordingly. So 2008, you get the double digit ratio. Price per barrel went to 150. So went from 11 to recent low back then, went to 150. Price per gallon went to $3.27, and this is the ratio. It's usually like 2 to 3% here of the price per barrel. So let's fast forward until current times. So you can see that it was over. Let's say overbought, oversold, whatever one you want to use. Then it goes back to the swing. So now we could expect it to do what? It's going to go up like the wintertime or like the summertime temperatures. So it goes up. Now look at this. 400, 2015. You know that this 400 is too high. 200, you're not making a move either way. 400, it's too high. 500, you already know that number's too high. It's not sustainable. You're looking at 36 per barrel. Let's see when it was 36 past these recent times. You're talking about 2004 prices. Meanwhile, the money and economy was just flooded. So here we are, 2016, 500 ratio, 500, 400. So you can see it was kind of going down. 2018 was going down to 300. Now it's spiked up as of recently. This is data in December, as of December 2018. Right now, The ratio is 500. Dow is at 22,000, price per barrel 45, right? If you want to just get the price per gallon at the pump, you could just take about 4% of this number here. But we're looking at projections, so that really doesn't matter. But right now, if you look at these projections, okay, let's say the Dow, right now Dow's 22,000. If the Dow goes to 18,000, which is possible, or if it just goes to 20,000, which is only 10%, you have this double-digit ratio. And I took the high route here. I didn't go to 50. Initially I went to 90, right? This gives you a price per barrel. You take this number divided by this number, you get this number. This gives you a price per barrel of $200 oil, $220 oil. You take 4% of this number, you're looking at $8 at the pump. $8 oil, $8 oil. Let's say the Dow gets to 16,000. 90, you know the ratio by now. 90, you're looking at $177 oil per barrel. You're looking at $7 at the pump. Let's do, it always goes to 50 at least. Let's see 2008. What did it go to? 58. And that's just the average, I think average for the year. It's not even, for a point in time, it's not even like the high and the lows of that year. You got 50s here, 50s, 30. We didn't even go to 25, 35 or 24. We're just going to 50s, right? So we go back down. Let's see. If we go to 50 ratio and the Dow is at 18,000, you're looking at $360 price per barrel. Dow goes to 16,000, you're looking at $320. The higher this number goes, let's say if you say, hey, the Dow isn't going to go down. If you don't think the Dow is going to go down to 18,000, the 360 number will be even higher. That's the thing. So I'm kind of being helpful here with this 18,000, 16,000. If you give it a ratio of 50, you're looking at 360 barrel, 320 per barrel per gallon. You take 4% this number, you're looking at $14 oil per gallon at the pump. You're looking at $12, $13 gas at the pump. So you can see with this data that the price per gallon that you pay for gas is set to explode. So when you have to wonder why prices are so high, this is why they're high. You're not going to find many other channels or YouTube videos with this type of data here. So price per gallon for oil or for gas is set to explode. And I'll just show you one more. I never like to look at one chart. I like to look at multiple. You can even see the gold oil. I should just show you this quickly. You can even look at the gold to oil ratio. I'll show you in another video. I have gold projected to be $3,000 to $5,000 per ounce. And you can see this here is just a regular. This is just a regular ratio of how gold moves to oil. Let's say that the gold price gets to, as I have projected, 3,000 to 5,000. It's about 1,200 now. And you get a ratio of just 10. We've been at 10, 1970s, as I showed. You get these wild swings. 2000s, we were at 8, 6. So let's just say a 10. It's kind of like it's not a high price of oil right here. But let's say we get to 10. If we get to 10 on a 3,000 to 5,000 gold price, even a $1,200 gold price, you're looking at 120 per barrel, 300 per barrel, and 500 per barrel. This is going to happen. It's inevitable. It's just a regular cycle that occurs. A lot of things in the universe are cyclical. A day, a month, a week, the spin of the moon, the spin of the earth, life, death. A lot of things operates in cycles. So you're looking at $8 to $14 per barrel. If you like videos like this, or per gallon. If you like videos like this, subscribe. More content coming soon. Thanks for watching. To subscribe for more financial content, please click the circular button where the red arrow is located, and also watch one of the top 2 videos up top.